What we're going to be going over here is pension accounting, where we're going to have some pension gains and losses on our pension account here for the company. Now, really, our gains and losses either can be attributed through what we would have for an actuarial change in our projected benefit obligation here, and it would either be an increased liability to the projected benefit obligation or a reduction in our liability here. But in their example, we're going to look at an increased liability in our PBO account here, and it's going to be due to some new actuarial estimates here. And then secondly, what we'd have for our other gains and losses would be the expected return on the plan assets versus the actual return here. So those are really the two types of gains and losses that we're going to have, and we'll just go through a basic example here. And these gains and losses would be recorded in other comprehensive income account here as a gain or loss, and this would be an equity account here on our balance sheet. So we'll just go through an example here, and I've got it laid out in pension worksheet format here. Okay, so what we have is really 7 different accounts that we have to deal with here, but I'm showing, starting with the pension expense. That's the annual expense here on the pension plan, and what I'm showing here is it's going to be in thousands of dollars, and then after each of these numbers are debits and credits here, I've got A, B, C, and references, so you can cross-reference your debits with your credits. So let's just go through our example here. We're going to have some service costs and some interest cost here on the pension plan here, and that's going to increase our pension expense here. But what we're going to look at a gain here, an unexpected gain on the actual investment or the actual return here on the pension plan on those, what the return on the assets were. So this is what we're going to look at here and how I would record it. So let's just look at the case here where we're going to have the expected return on the plan assets was estimated to be $44,000, but at the end of the year here, the actual return was actually $64,000. So you can see here, you're going to look at the difference between the expected return versus the actual return. So that's going to be either an unexpected gain or loss. In this case, it's an unexpected gain here of $20,000 because we only expected to receive or have a return of $44,000 and the actual return was $64,000. Okay, so moving over to recording it here as our pension expense. Now we're going to reduce our pension expense here, credit it by the actual return that we had here of $64,000. But based on our expected return of $44,000, this is where we're going to actually debit or increase our pension expense by that unexpected gain of $20,000. So we're getting our balancing amount here between the actual return of $64,000 and the expected return of $44,000. So pension expense gets increased by the gain here of $20,000. And then further on our pension expense, we're going to have some amortization of a prior service cost here of $10,000. So what we want to look at is our year-end amounts here. Summing your debits and credits, you're going to come up with your pension expense here for $126,000. So that's what we're going to be recording in our journal entries. Okay, so we've taken care of our first, in this case, it was an unexpected gain here, due the return here on our plan assets. Okay, then finally, let's go look here, moving on here in our cash account. We're going to have some contributions to the pension plan here of $105,000 for the year here. So that's going to be our year-end amount here, $105,000. Now, let's move over here, and let's just work with really what we've got, this other comprehensive income here. And that's on our an equity account here on our balance sheet, and we have to break that out here between the prior service cost amounts here and any gain or loss here on the pension plan. And we break them out here. Remember, they're equity accounts here on the balance sheet, this other comprehensive income. So first, starting with our prior service cost here. Well, we had that amortization of our prior service cost as an expense to the pension plan here of $10,000 that we debited on our pension expense. Now we would credit or increase our other comprehensive income here for the prior service cost of $10,000. So that would be our year-end amount here, $10,000. Now, what we would do here, just looking at it, had we any beginning balance, in this case we had $150,000 as a reduction to other comprehensive income, so now netting our credit or an increase here of $10,000, our end of the year amount would be $140,000 here in other comprehensive income for our prior service cost. Okay, so now this is where we want to move over to, and this is what the problem's about here, how we take care of our gains and losses here on this pension plan. And we're just looking at two different, a gain and a loss here, and that's again in our other comprehensive income as an equity account here. Okay, so the first thing we'll deal with is that unexpected gain here in the return of our assets. Now moving over here, you see that was the unexpected gain here was $20,000. So what we would do here is we'd credit or increase our other comprehensive income by the $20,000 amount. Now remember, in our pension expense we had debited it here, so the associated credit entry goes to other comprehensive income under the gain and loss account here. So credit or increase that here for $20,000. Now let's move down here and we're going to look at the example here where we're going to have a change in our estimate to our pension benefit obligation, where we're going to be, and let's move down here, and it's going to be $100,000 here, our change in our estimate to it, and it's going to be an increase in the liability. So in this case, let's just look at it. We're going to debit or reduce our other comprehensive income for the gain and loss for that $100,000 change in estimate. Let's go down and look at it. Okay, so where the change in estimate comes in is through this projected benefit obligation. That's the liability, where we keep track of the liability here on the pension plan. And what we're going to have here, we'll go through the numbers, but we're going to have an actuarial change here. That is, we've made a new estimate here, and we're saying that our liability on this pension plan is going to increase here by $100,000. So we would credit or increase our liability by $100,000. So that's simply a change here in our PBO benefit obligation or our liability, and that's going to be an unexpected loss. So you can see the unexpected loss, we're going to credit or increase our projected benefit obligation by that, and that increases an increase here in the liability. So just moving back up to our other comprehensive income for our gain and loss, we would debit that here for this unexpected loss, or reduce our other comprehensive income for the unexpected loss. So that's the change in estimate here, and the PBO increases for this unexpected loss, and that means that other comprehensive income account here decreases for the unexpected loss that we have. So at the year end, let's just net everything out, debits and credits here for the year. Well, what do we had? We had a $20,000 gain here due to the unexpected gain due to the increase in our actual return over the expected return, and then we have that increase in our actuarial liability here on our projected benefit obligation of $100,000. So our credit here, our debit here is reduced by our credit of $20,000. So year end we got $80,000 sitting in our other comprehensive income. So one gain here offset the loss, gone to reduction in our other comprehensive income account here, and then the gain was an increase here. So we offset our gains and losses here and come up with the net amount for the year, and just say our beginning amount in the year we had a zero balance, so ending at the end of the year here we got $80,000 reduction in our other comprehensive income due to the fact that our unexpected loss here was greater than our unexpected gain in this example. And then moving over here, we have to determine what our pension asset and liability would be on this for this example. So what we have to do is we have to determine what our beginning balance would be in that. So this is the case where we go up to look at our projected benefit obligation, our liability account, and compare it to our plan assets here, asset account here that on the pension plan. So all you want to do is look at the compare your plan assets here. Let's look at it. Beginning X1 here for our PBO or our liability here, projected benefit obligation, we have $700,000. plan assets were sitting at $640,000 to fair value. So all we want to do is make the comparison here. So when you're making that comparison, you have to look at your guidelines here. In this case, you have to look at is the projected benefit obligation is greater than our plan assets, then you're going to have a pension liability. So you would credit or reduce your pension asset account or increase your liability by $60,000. And that's simply the fact here. The projected benefit obligation sitting at $700,000, and our asset amount here on the plan, our pension plan assets, are only $640,000. Okay, so there's where we get our pension asset and liability. We have to determine it for the beginning of the year here. Now, the other case is if our PBO here was less than our plan assets, then you would have a pension asset, and you would be debiting or increasing your pension asset account here, if that was the case. It isn't the case here. Our liability is greater than our assets, then we have to credit it or reduce our pension and asset liability account. Okay, and then what we're going to have to do in this account here, we're going to have to determine what we would be including in for our year, for the year here, for our pension asset, our pension either asset or liability. We have to determine what the year end would be here, and that was, well, we had $91,000, what we would be including in this case for the $91,000. And really that's the difference between the end of the year amount in your pension asset and liability versus your beginning of the year. So what we're going to do is we're going to have to go down and we're going to have to calculate what our end of the year amount would be in our pension asset and liability account. We know what the beginning is. We have to determine what the end of the year is. So let's go down and look at it. So this is what again we're dealing with our pension projected benefit obligation, our liability versus our plan assets. And let's just go through what we would have included here in our projected benefit obligation here. So beginning amount, again, we had that credit or increased it here by $700,000. Then we had some service costs, some interest cost here, and then we had, this is where we had to increase the projected benefit obligation here for the actuarial. We're saying that our projected obligation for the pension plan is now increased by $100,000. So, and then finally here we have some benefits that were paid to the retirees on the pension plan. So we debit or reduce our projected benefit obligation by that amount here. So netting our credits with our debits here at the end of the year, we're going to come up with $920,000 worth of our projected benefit obligation is a liability on our pension plan. And then comparing that to our plan assets, again, we started out with a beginning of the year $640,000. Now this is where we get the return. The actual return here on the plan assets was $64,000. We didn't use the expected return. We put in the actual return here. Increased our plan assets for the actual amount here, $64,000, versus the expected return was $44,000. But just remember, actual return gets debited or increase our plan assets by that amount. And then we had a cash contribution to the pension plan here of $105,000, so we increase our plan assets by that amount. And then the benefits paid for the year here were $40,000 here to the retirees, so that would credit or reduce our plan assets. So here we're coming up with the end of the year balance in our plan asset account here of $769,000, and that's the fair value. So compare that with the projected benefit obligation liability here of $920,000, and you're going to come up with what you're going to need at the end of the year X1 here in your pension asset and liability account is a credit or reduction to your pension assets or increasing your liability by $151,000. So you can see what we need here for our year X1. The plugging or the balance amount is really the difference between, we start out with the beginning balance of $60,000, we have to end up with $151,000, so we're going to have an increase here in our pension asset and liability account as a reduction to our asset or increase in our liability of $91,000. And that's simply just looking at our guidelines here. This is the case where our PBO here, our pension benefit obligation is greater than our plan assets, then you're going to have a pension liability. So that's, we first have to determine what our beginning amounts were and our end of the year amounts here to determine what we have to include here for the year for our pension benefit obligation, our pension asset and liability account. Okay, so we've done that. Now we could have looked at it in a different fashion here, just to cross-check what we have done here. So let's just go down and look at that here. So again, what you would do is it's going to be a plug, because these are the 5 different accounts that we're going to be dealing with when we make our journal entries at the end of the year here. So first we'd have what we calculated for pension benefit expense. We would have debit that for $126,000, and then our other comprehensive income, we had an $80,000 debit amount there that we calculated here. And then funding, and then we're going to look at our credits here. So we know what our debit amounts are. So now looking at our credit amounts, our funding or our cash contribution, we had credited that here for $105,000. And then we have the amortization of our prior service costs at $10,000. Then the pension liability, we calculated that up above here to be $91,000. But it becomes a plug between our debits and credits. So if you look at your debits and credits here, you're going to have to come up, this is going to be a plug here, you're going to have a credit of $91,000 here in your pension liability. Okay, so that's how you'd have to determine your pension asset or liability that would be included for the year end here. And it all depended on these 5 different accounts. These 5 accounts here. So let's go over and let's look at how we'd record this here for the year. So these are what would be included in our journal entries for the year. So we're going to have pension expense, debit that here for $126,000. Other comprehensive income, it was a net loss here of $80,000 for the year here, and then that was another debit here. And then our cash account, we would have credited that here, reduced it by $105,000. Then we have our other comprehensive income for a prior service cost of $10,000, and then this is where we had to calculate that pension liability as a balancing amount here of $91,000. So your credits here, balance with your debits. And these are what we include in our journal entries here for the year end. Now, you don't see any projected benefit obligation or plan assets. Those are memo accounts, and those are keeping track of our, just keeping track of what our liabilities are on the pension plan versus our plan assets. But what I'm showing here is what we would record here as your journal entries. Okay, so that takes care of our example here, but let's just go up to it one more time here. And again, just looking at our 2 accounts here, just remember when you're dealing with this gains and losses here, you are included in the other comprehensive income, which is part of equity here, but they're separated out from your prior service cost. Prior service cost is recorded in a separate other comprehensive income account here versus your one for the gains and losses here on the pension plan. Now, remember, we could have had a gain or loss here on any one of the on our actual return versus our expected return. In this case, we had a gain on our actual return here was, in this case, was $64,000. Expected return was only $44,000. So you can see we had a gain here. We credit our other comprehensive income by the amount of gain here. Now, remember, if we had an unexpected loss, if the actual return here was less than the expected return, then we debit it or we reduce our other comprehensive income. So that's our gains and losses here on the pension assets or the investment that we have on our pension assets. And then the other gain or loss comes into, and let's go down and look at it just one more time. Or we can look at it just from this perspective here. That is the estimated increase or decrease in the pension benefit obligation. Let's go down and look at it here. So here's our projected benefit obligation as a liability here for the pension plan. So you can see here, we went down here and we credited or increased our PBO here based on the fact that we think we're going to have an extra $100,000 here in liability on this pension plan. So we credit or increase, and that's for the actuarial amount here, and that's going to be an unexpected loss here when we increase our liability here in our PBO account. And the other case here, if we had a decrease here, then what we would, in our projected benefit obligation, we would have debited here for the actuarial loss. So if we had said, okay, we're not going to have a reduction here of $100,000 in our liability, rather than credit it here for the projected benefit obligation, we would have debited here or reduced our projected benefit obligation by that amount. But you can see what's going on here. When you have to make some estimates, and if there is a change here in your actuarial estimate here on your liabilities on the pension plan through this projected benefit obligation, you either have to decrease it here or increase your liability. In this example, we increased our liability by $100,000, and in doing so, we have to go up here and we make any gains or losses go to our other comprehensive income account. We're under gains and losses. In this case, we had an increase in our liability, so we reduced our other comprehensive income by the estimate here of 100,000. But if we had, and that was called an unexpected loss. But if we decreased our liability, let's just say we decreased it here, then by 100,000, then we would have credited our other comprehensive income here for an unexpected gain. But we just looked at an unexpected loss here. Debit or reduce your other comprehensive income. But if it's an unexpected gain here, then you'd credit or increase your other comprehensive income. And then you'd have to do again the associated debits and credits in your projected benefit obligation. But we just went through a simple example here, and we just looked at some gains and losses that we'd have on the pension plan, looking at the actuarial gain or loss due to the future projected benefit obligation versus the expected versus the actual return here on the plan assets. Okay, so that'll take care of our example.